Steve Peterson here with Infinity Investments, and welcome to our channel where we talk all things commercial and investment real estate. In today's very quick video, we're going to be talking about the 4 things that 90% of real estate investors completely miss when they're doing 1031 exchanges. Now, these are very important things and you don't want to miss them when you're doing your exchange. So what are they? Number 1, you want to set a defined investment plan. What are we doing with our properties anyway? They should be leading us toward an eventual goal of whether that's retirement, whether that's having your passive cash flow from your assets pay all of your expenses, whether that's taking you from small time investor to the tycoon status. Whatever your investment plan is, we need to make sure that you have set down and define that. And therefore, marry what you're doing with this 1031 exchange with that plan. We want to get away from this whole idea of shooting from the hip. You don't want to be shooting from the hip when you're making investments. That's like the worst thing that you could do. You need to be dialed in to the actual plan, because when there's going to be challenges, and there's going to be challenges, you need a guidepost. And that guidepost is your investment plan. And ideally, that investment plan, you set it up as tax advantaged as possible. Meaning that, hey, you buy a small property, now it's growing in value. Now we want to try to exchange out of it, or we want to exchange not necessarily out of it, but up to the next property, right? We want to do that in a tax advantaged way. And that's why we're exchanging. Right, and maybe even you sit down with a financial planner or advisor and talk about when you're saving your money, how to do that in a tax advantage way. Very, very important. But the number one thing that most investors miss is they are not investing with a defined investment plan that has an end goal in mind. With the whole reason why you're investing in real estate should be to get you to here in X amount of years. All right, number 1. Number 2. You need to now define your investment criteria. Now, this goes in line with your investment plan. You see, if your goal is to get to 10,000 units by the time you're 60, paying you, $1 million a month, you're going to require a different rate of return than if somebody says, hey, I want to have 100 units by the time I'm 60, paying me $10,000 a month, right? Or somebody says, I want to have 1 building paid off by the time I'm 60, paying me $5,000 a month. Those are going to have different rates of return. Those are going to have different strategies of those goals are going to have different rates of returns, different strategies, different methods, maybe even different property types that are going to all be surrounding what your investment criteria is. Some people are going to buy properties that are already fully stabilized for the cash flow. Okay, their rate of return on that is probably going to be a lot less than if you say, hey, I want to get totally value-add projects that I'm going to buy at a discount, put the sweat equity in, get the rents up, get the minimize vacancies, improve the rents, improve the NOI. Then I'm going to exchange that property, move it to a bigger unit, and do the same thing over and over. So you're taking a little bit more risk. You're doing a lot more work when you're doing that, but your rate of return is going to be a lot higher. You need to figure out what your defined investment criteria is in relationship to your investment plan, so that when you're doing these exchanges, you could be dialed into that exchange based on what your criteria and your plan is. Okay, and a couple, just an example of things you want to have within your criteria. Number 1, rates of return in terms of cash on cash return. What are you actually going to make annually on your project, on your property? Also, you want to look at what the internal rate of return, what the long-term, it has to be over a period of time, 5 years, 10 years, whatever it is. That period of time, what are you going to make, not only from your cash flow, but your projected growth, your principal pay down, and your tax either benefit or liability. And then with your investment criteria, you want to have where are you going to invest? And maybe there's a couple different markets. If you're going to be a bigger investor, probably a couple different markets. And you need to have where down so that you can do the necessary research and build your teams in those markets. Okay, so other things to consider within your investment criteria. Those are just a couple ideas. The bottom line is you need to have a written investment criteria, particularly before you exchange. Now, the third thing is you need to evaluate your property's existing return on equity, because that is going to then tell you what you need to make in your up-leg exchange. So if your property has a certain amount of equity in it today, and then that equity is generating a certain amount of annual yield, right? And that annual yield that you're generating in relationship to the property's equity is your return on equity. So the bottom line, when we're doing an exchange, is to acquire a better asset. And that better asset should mean more income. Now, some people could say, hey, I just want to buy a property in a better location. So if that's your criteria, like we just talked about, fantastic. Most of you all out there, when you're selling your property, you want to make more money, and you probably want a better property, and maybe you want less management, but we want to do all of that with the idea that we really would like to make more money on the next move. So the money that you're going to have to reinvest on the next move is your equity in your property you have right now. So you need to figure out what that is today so you can figure out what you need to make tomorrow on the new investment. All right, some of you guys have excellent properties and you're selling out of excellent properties just so you can buy something bigger. You want to buy something bigger that makes less money. Not really the ideal plan. Let's be diligent about this and know what we're making on our equity now so we can determine what we're going to make on the next one. Now, some of you might be able to double your cash flow. That might be hard for everyone. All right, so be realistic in what the next move is, but you start with knowing what the return on your equity is today in order to make that next move. And the last thing you need to do before exchanging is decide on if exchanging your property is the right thing to do in relationship to your investment plan, based on your investment criteria and understanding what your property's current return on equity is, and then looking at the markets that you're going to invest in. And you've said, hey, I'm going to invest in my home market, I'm going to go invest in another market. What are the rates of returns on these properties that you see out there? Is it enough for you to exchange this property and move up to a whole product line? All right, if you've made those determinations, now it's time for you to exchange. And we've got a checklist, a 1031 exchange checklist that we put together that's got 9 points on it. So if you want to get more of those points, click the link below so we can get that checklist over to you and that you can stay tapped in with us with what we have. And I hope this information is helpful to you in your investment career. And if it is, like, subscribe, share with others, and continue learning and growing. And I'm wishing you the best of success in your investment career. To the next video, peace out. Y'all have an excellent day.